Hey everybody, Rob Maurer here, and today we're mostly going to be talking about Tesla stock. We have an updated note from JP Morgan. They have increased their price target from $80 to $90 per share, as I'm sure many of you have heard. So we will run through the details on that note, and even though we may not agree with the price target, I do always find that helpful as a jumping off point for my thoughts. But that's actually not the most interesting part of the note. They gave an update on their clients' perspectives on the S&P 500 inclusion process for Tesla. I thought was super interesting, so we'll go through that as well. And then at the end, I do have a personal update on the status of my Model 3 order. First up, let's take a look at the stock though. Tesla today finishing down 7%, one of its few red days since the S&P announcement, to $604.48. That compared to the NASDAQ down 1.9%. And while obviously the degree of Tesla's movement was more extreme, if you adjust for that, like the iPhone stock app is going to do, and then you overlay the two graphs, you can see that directionally they moved pretty much in lockstep throughout the day. I don't point that out to brush aside the negative day by any means, but oftentimes on days like this, I tend to get a lot more questions on, oh my gosh, why is the stock down? Or there will be people saying, look, the stock is down because of this $90 price target from JP Morgan. Isn't that ridiculous? And I just think oftentimes the macro impact is underappreciated. And I think if you overlay these graphs, that does demonstrate how impactful it can be. If you look at other companies that are, high-tech companies in the NASDAQ, you'll see a lot of similar graphs for those companies as well today. The other thing I would add to that is obviously the stock can't go up forever. Even in huge bull runs, you're going to have red days. All right, looking at volume today, about 69.5 million shares traded hands. This is actually the second highest volume day that we've had since the S&P announcement. It's about 135% to the average that we have seen since that announcement, and 105% to the average volume over the last year. So I think the stock price and the volume brings a question to mind. Okay, is the volume higher? And was the stock being maybe a little bit more pressured today because Tesla is issuing these new shares from this at-the-market offering? Remember when they did the same style of offering back in early September? It was announced on Tuesday and completed by the end of that week on Friday. So of the 7 to 8 million shares that Tesla would be offering here, if they do intend to raise that full $5 billion, I would imagine that we have seen at least some of those sold into the market over the last couple of days. And based on the finality with which Elon Musk was talking about it in his Wall Street Journal interview yesterday, I wouldn't be surprised if it's already been completed. I saw some people on Twitter today pointing out that, oh, if this is what happens if 7 million shares are added to the float, what happens when you take 120 million shares out? So I know that is said a little bit tongue-in-cheek, and I do understand the logic there, but I do just want to point out for anyone that's sort of thinking in that sort of mindset that there's no simple equation for us to say, okay, if the stock was down 7% because 7 million shares were added, the stock is going to go up X percent when 120 million shares need to be purchased, because the price is determined based on buyers and sellers. Just because you don't necessarily have any buyers and the stock price is falling doesn't necessarily mean that if you reverse that equation, that you're not going to have any sellers. As an example, let's assume there is a huge pool of people that has decided to front run this S&P inclusion. They've bought up these shares to temporarily hold, and they're going to sell them off on, the 18th or sometime around there. And for the example's sake, let's say, okay, they bought up 120 million shares. This is a huge purchase, but just as an example, they've got their position locked in. So if 7 million new shares are added and no one's buying them, this fund is not going to go ahead and buy more. They're not going to buy 127 million shares. They've already got their shares ready to go. And then sometime around the 18th, they're just going to sell them off to the highest bidder. So in this example, this front-running entity would not provide any support to the downside. They have no buying interest. But then let's pretend that the stock price is going up around the 18th. Well, this fund, they're interested in selling at that point. And of course, if they're looking to sell, and as they make those sales, that's going to provide some resistance from the price going higher and higher. So obviously the market is much more complex than that, but hopefully that can illustrate the differences in movements that can be caused by the strategy for all of the various different participants in the market on a given day. Each of us can extend that example to our own position. So for me, for example, I'm not doing any buying or much buying right now because I already have pretty much all the Tesla I can get. And if there are new shares being issued, well, I'm not buying them. I'm not providing any price support. But if the situation flips, shares become in demand, people are buying, I'm also not selling, so I'm not providing any of that relief like this front-running entity would have been. And the combination of perspective of every owner of every share, that's what makes the market on every single day, every single minute, which hopefully can clarify why it is so murky. All right, that being said, let's get into the JP Morgan note here and talk about what they had to say on the S&P inclusion. So as I said, they've increased their price target from $80 to $90 per share, but they open their note here by saying, quote, "We have recently fielded a number of calls from long-only investors who are faced with or shortly will be faced with the decision of whether or not to buy Tesla shares as the stock is added on December 21st to the S&P 500 index, given that many funds' performance is evaluated against this benchmark. Investors in the past have expressed to us that they do not understand why Tesla shares are rising as much as they are, but as the stock became included in indices against which they are benchmarked, e.g. upon NASDAQ 100 inclusion in July 2017, they opted anyhow to take it to equal weight in their portfolio relative to their benchmark so as to concentrate on generating alpha in other areas of the market in which they felt they have more of an edge. End quote. All right, so let's break that down because this is exactly what we have been talking about with the S&P 500 tracking assets. So in this case, JP Morgan is talking about managers of funds that are benchmarked against the S&P 500, meaning their compensation is basically determined or heavily influenced by the performance of their fund versus the performance of the S&P 500. The index is their benchmark. So at the beginning of this year, the S&P had said that about $6.6 trillion in assets are benchmarked against the S&P 500. Tesla at $604 per share at its current weight in the index would be about 1.5% of the S&P 500. So that means of those $6.6 trillion in assets, 1.5% of that should be Tesla stock if all these funds were equal weight. That equates to about $98 billion or about 162 million shares of Tesla, 21% of Tesla's float share count. And of course, as we have talked about many times, these are the benchmarked funds, so this would be on top of the tracking funds, which literally just try to replicate the performance identically of the S&P index, the tracking funds, that is. So what JP Morgan is saying here is that the managers for those benchmark funds are calling them saying, hey, we don't know what to do with Tesla stock. It's super highly valued right now. As it comes into our benchmark, we need to make a call on it one way or the other. So they're saying a similar situation happened back in July of 2017 when Tesla was apparently added to the NASDAQ 100. And I haven't looked back at that, so we probably should do that at some point. Obviously not as significant as the S&P inclusion, but JP Morgan is saying at that point, the clients that were benchmarked against that said that they decided to pretty much just take it equal weight into their portfolio, which is what we have talked about before, because if they don't do that, then Tesla's performance will be one of the reasons their portfolio varies in performance from their benchmark. And if they don't have strong conviction on Tesla one way or the other, the simplest solution is just to go ahead and add it at equal weight so that it doesn't affect the variance in return. That's what JP Morgan is saying here when they say they can concentrate on generating their alpha or their excess return versus their benchmark, their variance, in other areas of the market which they have a better understanding of and more of an edge. So here, if we remember back to that Bloomberg article from a week or two ago that we had talked about, Bloomberg had said that as of their most recent filings, so this could have changed, but as of the most recent filings, 93% of those benchmarked funds did not have a position in Tesla. So obviously those benchmarked funds, they can buy whenever they want. It definitely doesn't need to be the day of inclusion or anything like that. And probably many of them already have added, but from what we're seeing so far, all the information that's coming in, it certainly seems like there's going to be a pretty decent amount of demand for Tesla shares from these benchmarked funds as well. I remain very curious to see how this is all going to unfold. As for the JP Morgan note, they say, quote, "We recommend investors not raise their holdings in Tesla to approximate its weight in the benchmark," end quote. And that was in bold in their note, and they also underlined not. They explained that recommendation by saying that it is, quote, "because Tesla shares are, in our view, and by virtually every conventional metric, not only overvalued, but dramatically so," end quote. There they cite valuation metrics such as last 12 months, price to earnings, projected next 12 months, price to earnings, price to sales, etc. All things that we pretty much addressed last week in the Goldman Sachs price target episode, in case you missed that. In this section, they wrote something that I had to kind of chuckle at. They say, quote, "Tesla's multiple of earnings is very high in nominal terms for any company in any industry at any time in history," end quote. So I would say citation needed on that, because if you have a company that's not profitable that then flips to profitable, you're going to start out with a high price to earnings ratio as you build that profitability up. That's just the basic math of it. If you look at Facebook, they've traded over 1,000p in their past. Amazon has traded over 1,000p in their past. Shopify has traded over 1,000p in the past. They actually just flipped, like Tesla, to showing positive earnings. So their price to earnings right now is like 660. That's just how this works. The problem with JP Morgan's analysis, as we've talked about with their previous notes, is they're only looking at Tesla on a 2-year basis. So the furthest they're modeling out is year end of 2022. Well, yeah, of course, if you build Tesla's valuation on where they're at the end of 2022, you're probably going to come up with an overvalued stock. On top of that, their forecasts for 2022, in my view, are very conservative. They're modeling for $43 billion in sales, year of 2022. That's well under 1 million vehicles per year. If you assume, maybe 10% of revenue coming from services and energy, and let's say about a $45,000 average selling price on vehicles, that's only about 850,000 vehicles full year 2022. Remember, when recently discussing Giga Berlin, Elon Musk said they're trying to get to a production rate of 500,000 per year by the end of 2022, just for Giga Berlin. Tesla's current total production capacity across all factories is about 790,000 per year, and I actually think it's a bit higher than that based on Shanghai current production. But if you even just add 500,000 to today's capacity, you're already at 1.3 million. That is before Shanghai Model Y and before Giga Texas. That's probably another 750,000. So you're probably at 2 million production capacity end of 2022 under relatively conservative assumptions, at least based on what Tesla has achieved so far in the ramp up of Gigafactory Shanghai. So yeah, I would say 850,000 is a pretty conservative forecast. You'd have to discount pretty much all of that progress happening in the next 2 years. So they've got a super conservative forecast. They're also only looking forward 2 years, and they somehow feel like that level of analysis qualifies them to be able to give advice to their clients to not make Tesla equal weight and to risk their alpha because of that decision. At least punt, at least be like, I don't know, Tesla's pretty highly valued. We obviously don't understand it, so maybe just put it equal weight for now until we do. But to recommend against it based off this analysis to me seems honestly completely irresponsible. Now, to their small credit, I guess, for lack of a better term here, they do say in the note, quote, "We concede it is possible the rise in the shares could be grounded in an analysis of the fundamentals other than those reflected by consensus estimates through 2024, end quote. So they're at least acknowledging that some of Tesla's price today could be based on their performance for years beyond 2024. Pretty novel concept, I know. But to sort of combat that line of thought, they say that they don't really believe Tesla can grow into the valuation because, quote, "After all, are Toyota, Volkswagen, GM, Honda, BMW, and Mercedes at all simply going to sit back and watch this happen?" End quote. Well, I would say past performance is not a perfect indicator of future results, but maybe we should consider that so far that's pretty much exactly been what's happened. And at a certain point, which I think we've passed long ago, it no longer becomes a choice. It's not like those other automakers are sitting around the drawing board trying to come up with their first electric vehicle. They have put electric vehicles in the market. They have given their effort now. They have tried, and they have not succeeded in competing with Tesla. The last part of this note that I have to mention, and then we'll move on, they have I have in my notes here, I say, most hilarious take on regulatory credits I've ever seen. I didn't intend to say that on the podcast, but that is the solid truth here. They say, quote, "We would point out, though, that the beats this year were helped in large part by much higher regulatory credit sales, which probably will not be a material factor in earnings as far out as 2030 or 2035, by which time multiple countries have suggested they may ban the sale of new internal combustion powered vehicles, reducing or eliminating other automakers' needs for credits, suggesting that the recent momentum versus consensus estimates may be less germane to the years much beyond 2024 and certainly to terminal value." End quote. So yes, as I've said many times, I agree regulatory credits are not going to be around forever. I'm fine if you want to exclude those from the valuation, but to use the complete banning of internal combustion engine vehicles as an argument against Tesla, well, that is an argument that I have not seen made before. It takes some mental gymnastics to get there, so kudos to JP Morgan for pulling that one off. All right, getting too riled up here. Let's move on. As I said in the beginning, I do have a personal update on the status of my Model 3 order. Reminder, this was placed on October 16th, and I now have a vehicle identification number, finally got my VIN, and it sounds like it is now on a train on its way to Chicago for delivery in a couple of weeks. A few of you have asked about the status of that, so I wanted to give an update. And I also wanted to just ask here if anyone has any recommendations for an auto detailer. I am looking to do a paint protective film on at least the front. So if anybody has any recommendations in Chicago or southeastern Wisconsin, please let me know. And for their part, hey, it might be a good opportunity for a little bit of YouTube exposure. All right, last thing today, I just want to say a huge congratulations to SpaceX on the test today for Starship serial number 8. We had mentioned this upcoming last week. This did finally happen today after a few delays. I mean, this was incredible. If you didn't have a chance to watch it, go back and watch that live stream on YouTube, SpaceX's YouTube channel, or watch the Everyday Astronaut live stream. He does an amazing job, and there's a little bit more emotion in that channel. But for this test, the launch was successful. The Starship did its belly flap maneuver, made its way back to the landing pad. All huge accomplishments, and it almost stuck the landing, but not quite. Instead, there was an RUD, rapid unscheduled disassembly, or what us normies might call an explosion. Shortly after that though, SpaceX put a message on screen saying awesome test, congrats Starship team. And Elon was obviously thrilled on Twitter saying successful ascent, switch over to header tanks, and precise flap control to landing point, and quote, fuel header tank pressure was low during landing burn, causing velocity to be high, and RUD, but we got all the data we needed, congrats SpaceX team, hell yeah, end quote. Before the test, Elon had said that they had maybe a third chance of completing all the objectives for this test, so for them to get as far as they did, and come as close as they did to landing, obviously a great result. In his excitement afterward, Elon tweeted, Mars here we come, and for me, at least, watching these tests, it's definitely feeling more and more real, and as excited as we all are for the next couple of years from Tesla, the next couple of years for SpaceX are going to be just as exciting, if not even more so, continuing to watch SpaceX head down this path. So next up will be Starship serial number 9, and we'll try to keep track of that as much as we can here on Tesla Daily. That will do it for today though. As always, thank you for listening. Make sure you're subscribed and signed up for notifications. You can also find me on Twitter at Tesla Podcast. Otherwise, I'll see you tomorrow for the Thursday, December 10th episode of Tesla Daily. Thank you.